This video is sponsored by Morning Brew. Visit the link in the description below to sign up for their daily newsletter today. Ladies and gentlemen, welcome to The Plain Bagel. I'm your host, Richard Coffin. Hindenburg Research is back in the news. The short-selling firm that took a big chunk out of Adani Group, the massive Indian conglomerate that still hasn't fully recovered from short-selling report on them, they are at it again trying to take on a pretty big publicly traded stock. They got a lot of flack last time for targeting an Indian company, with some believing that they wouldn't do the same sort of coverage for an American firm, to which they've now seemingly replied, all right, bet. With their latest report being on an American icon, Carl Icahn, to be exact. But jokes aside, Carl Icahn is a very famous investor and is sort of a trailblazer in the world of activist investing, where someone buys a large position in a firm and then tries to force changes upon how that business is run. With him also having a bit of a reputation as a corporate raider, someone who buys a business and then takes it apart, selling the pieces separately. And it's made him a very wealthy man, taking spot 36 on Forbes 400 list for 2022. Of richest Americans. But it's looking like next year he might be a little bit lower on the list because this Hindenburg report has allegedly wiped out $10 billion of his fortune, with the report going after a firm that he largely operates, Icahn Enterprises, with the publicly traded stock falling 40% this week alone as of Thursday close, with Hindenburg alleging that this company runs a Ponzi scheme style hedge fund. So with these tall claims, I figured that I would read the report so that you don't have to and explain what they're alleging here. And because this is a publicly traded stock, as always, I'm not recommending a buy or a sell here. And I don't even want to continue covering short reports from Hindenburg. I do generally like to be kind of stock neutral on this channel, but given the pretty big claims about a very famous investor, I thought I'd cover anyway. So let's start at the beginning. What is Icahn Enterprises? Well, the company is organized as a limited partnership that invests in stocks and actually runs a few operations itself. About 45.4% of their gross indicative net asset value is in Icahn's own investment fund, meaning that this vehicle invests alongside Carl Icahn. 27.8% is in Icahn Automotive Group, which runs a number of automotive businesses. 12.9% is in CVR Energy, a publicly traded energy stock, and the remainder is in a number of other subsidiaries. And all operates as a sort of fund that allows investors to basically operate under the guidance of Carl Icahn, with a bit more of an active piece to it, given that it does actually have operations, being very similar to like a Berkshire Hathaway run by Warren Buffett, for example. And according to this report, Carl Icahn and his son Brett actually own roughly 85% of Icahn Enterprises, so they have a big stake of their wealth in this firm. And what's notable about this stock, and what the report sort of hones in on, is that it had a dividend yield above 15% before this short seller report came out, which is very high. In fact, one of the highest dividend yields of large cap companies. And the report argues that this dividend is not only unsustainable, it's essentially a Ponzi scheme where new investor money is helping to fund it for older investors. Now, I am going to leave out a few examples I touch on. There is quite a lot to go over with this report. But the short thesis really boils down to three main points. The first being that they argue that the stock is very grossly overvalued in terms of its price to net asset value, which they believe is because of their unsustainable dividend. Secondly, they say that the company's net asset value is falling and actually inflated as it is due to some questionable value marking practices. Finally, they highlight that debt of the company and of Carl Icahn himself pose significant risks to the firm's operations. So let's go through those three arguments and see what's going on here. Starting with the NAV valuation. For those unfamiliar, net asset value, or NAV, is typically a fund term used in other areas as well, but it refers to the value of a company or fund's underlying holdings with a deduction for any sort of liabilities or fees. So if you had a mutual fund, for example, that had 10 stocks, 10 publicly traded stocks, the NAV would be the sum of those 10 stocks market value. And many holding companies, and in fact, exchange traded funds as well, actually trade at a discount to their NAV, with that discount being higher the more complex the operations or the more expensive the fees. Yet one of the first points highlighted in this report is that IEP, the ticker for Icahn Enterprises, is actually trading at a premium of 2.2 times its net asset value. So technically, the market value of this holding company is actually larger than the market value of what it's made of. Now, Hindenburg believes investors are willing to pay this higher premium because, on the one hand, they get to invest alongside a very famous investor, Carl Icahn, and secondly, because of that high dividend yield. But as I get into, again, they don't believe that that dividend is sustainable. They point out that the company frequently has negative free cash flow, which is its operating cash flow less capital expenditures. And they argue the only reason the company is able to pay this dividend is because Carl Icahn himself takes his significant cut of that dividend in units, which reduces the cash outlay required, but causes pretty significant stock dilution, which, if you do look to quickly verify, the share count has increased at a 5-year cumulative average growth rate of roughly 15%. On top of that, they argue that the company is issuing new shares publicly as well to bring new investor funds in, and then those funds are being used to help pay for that dividend, which is where that Ponzi scheme claim comes from. And going further down the rabbit hole, they highlight that all these stock issuances have been done or facilitated by a single investment bank, Jefferies, which also happens to be the only firm that provides research coverage of Icahn Enterprises and rates them a buy. And to top all that off, they highlight that Carl Icahn has deep ties with this company, knowing the founder and having helped actually bail out the company following the 2008 financial crisis, with them basically alleging that this investment bank is helping funnel money into Carl Icahn's business to help kind of pay out older investors and keep things running with a positive research recommendation. So that's the first part. They say the stock is too expensive relative to its NAV, and that gap has appeared because of its unsustainable dividend that operates as a sort of Ponzi. The second point is that even without that valuation gap, the NAV itself is falling, if not fully misrepresented. Hindenburg argues that the company's largest NAV component, which is the Icahn investment fund, has actually fallen by 53% in value since 2014. And outside of their reported performance, they also believe the fund is likely down year to date as well, highlighting that the fund has a big net short position, which would obviously suffer if the market were increasing like it's done in 2023. And using Carl Icahn's 13F filing, which is a filing institutional investors have to file that shows what positions they hold, to argue that the fund's long positions are down year to date as well. And that's just for roughly half of the company. There's also CVR Energy, which itself a publicly traded stock is down year to date as well. And they point out that the private automotive segment has negative operating cash flow, and is likewise not doing very well. But more concerning than that performance is, again, the claim that these net asset values are also inflated, with the report highlighting a few examples of the company seemingly taking a position that they hold and overvaluing it on its books, with one of the strangest examples being for a meat packaging company, Viscase, that is publicly traded with a market cap of $88.7 million, where IEP values its own 90% stake in at $243 million. About 3 times the market value of the whole company. Worse yet, if that wasn't suspicious enough, it looks like the company acquired roughly $1 million more of that firm and then immediately wrote up the value of those shares above what they had actually paid for them on the open market. Now, the reason for this discrepancy is that IEP is valuing Viscase using an adjusted EBITDA multiple of 9 times, which isn't totally unreasonable. It's quite common to use that sort of approach with acquisitions. And this is a thinly traded stock, meaning that there's not a whole lot of buyers and sellers out there. So I guess you could argue that the market cap isn't totally reflective, but even still, the report makes a good argument that typically when you have an illiquid market for an investment, you actually apply a discount to the value, not a premium. And it's not just Hindenburg Research that seemingly has had a problem with this sort of valuation approach, because UBS actually dropped their coverage over that similar issue, with them highlighting that the values the company was using to value their businesses was, quote, divergent from their public market values. Now, the final point of the thesis is again around the debt of the company and around Carl Icahn himself, with the report highlighting that the business has a lot of debt coming due, with $1.1 billion coming up in 2024 alone. And these debts, as you would imagine, have very low interest rates and will need to be renewed at much higher interest rates given the rising rate environment we're in. And they highlight that 60% of Carl Icahn's units are actually pledged for margin loans. And the report argues that with Carl Icahn having most of his wealth tied to this company and with his potential liability from a margin loan, not only might Carl Icahn not have any more wealth to put into this company should they run into hard times, but he might actually experience a sort of margin call or other sort of loan requirement that forces him to sell a significant chunk of his ownership, which naturally would batter the stock price. With him concluding that with no real disclosures around this debt provided to investors, there's a big question mark here around the risk posed to them, and naturally that presents a lot of risk to the position. And that's more or less the report. As you can see, pretty scathing and what some have called ironic, given that Carl Icahn himself has quite the reputation for doing this sort of work about other firms, and even going so far as to sue and, like I mentioned, corporate raid other businesses. And there do seem to be merits to some of the claims. The investment fund definitely doesn't seem to have done very well, and operationally, with most of the sales of the company coming from CVR Energy and Automotive alone, those two businesses actually make up 94% of the company's revenue. The negative stories around those two businesses themselves are obviously important to how the business is going to do. I would say that there's a lot of speculation around the year-to-date performance. Yes, there are some clear negative indicators there, but just to quickly highlight, the 13F, for example, is quarterly filed at the end of 2022. So the report's assuming that this fund hasn't done any trades, which obviously might not be the case. And with the private companies, while the report does highlight some negative things like bankruptcies or defaults on different debts, there's just individual data points, and you can't really, grasp the whole health of those businesses based on that one singular thing. And really, that's kind of the tricky thing with this business as a whole, with a Icahn enterprise or something like it. Holding companies are very complicated to analyze because you basically have to understand every business that's under its umbrella. And that's why a lot of holding companies do trade at a discount, because it can be very difficult for a single manager to get a grasp and run all these different types of businesses very effectively and, to the best of their capacity. But one thing I do want to highlight about Icahn Enterprises, not necessarily to defend them, but just to add some more detail to put this report in perspective, is that some of these points would be expected with a company like Icahn Enterprises, not all of them, like the valuation stuff. But Icahn Enterprises seems to follow a sort of asset or capital recycling strategy, where it's a sort of value investing approach where you buy an underperforming asset, try to improve it or make it better, and then sell it for a profit. And it's a very valid strategy. And because this firm is actively seeking out distressed businesses or assets, bankruptcy is actually part of the strategy. It can actually be advantageous depending on the circumstance. And Icahn Enterprises even states in its business strategy section that part of its strength includes managing complex legal, regulatory, or financial issues, which may include bankruptcy or insolvency. Now, one of the reference bankruptcies is for auto parts, which, based on the press release, did seem to be a very disadvantageous outcome for the company. But it's all to say that this is a common occurrence for a business that pursues such an aggressive turnaround strategy. Keep in mind, sometimes the best thing for investors is to liquidate everything that a company owns, because the operations are worse than just the sum of the parts of the asset value. I'll also quickly point out that the cash flows from an asset recycling strategy are pretty lumpy and wouldn't be fully reflected in the operating cash flow. So you would have to have a more comprehensive view of cash flows to better assess the business. Nonetheless, there are still a lot of red flags here. And I think the drop we've seen in the stock price of Icahn Enterprises reflects that there does seem to be some merit behind some of these claims. For example, paying such a high, consistent dividend for such a lumpy business obviously would be very financially straining on the company, and there's no questioning the aggressive nature of the valuations this company uses. I also think share-based compensation and share-based dividends, I guess, are really an overlooked aspect of investing, where a lot of people assume it doesn't really matter the number of shares being issued. At the end of the day, if a company is issuing shares to operate, to continue doing whatever it's doing, that's still a cost to the investors. And if a company is slowly diluting your percentage ownership of a firm by issuing more and more shares, you'd best be sure that whatever they're using that for is worth the cost. Now, since this report's released on Tuesday, Icahn Enterprises has responded, not with anything really of much substance, just kind of arguing that Hindenburg's report is self-serving, which it is. But we'll have to see what comes from here. Ironically, with the share down as much as it is, it will actually impact the business's ability to use share issuance to pay dividends or whatever have you. So it's going to have to prove its ability to operate when it can't rely on a higher stock price to cover some costs. Anyway, that's the situation. I hope helped to clear things up. And before I go, I do want to give a quick thank you to the sponsor of today's video, Morning Brew. I've been working with Morning Brew for quite some time now. I was actually subscribed before I started working with them on the channel, and they're genuinely one of the first things I read every day. They're a great finance, tech, and business newsletter sent to your inbox 7 days a week. They cover a lot of ground to tell you the happenings of the day. For example, this week they talked about the Hindenburg Research and how it cut Carl Icahn's net worth nearly in half. Rough hump day. And one of the best things is that even though it is insightful, it is a relatively light read. The writing is witty, there are jokes spread throughout it, and it's an enjoyable way to start the workday. So you too can sign up for Morning Brew for free using the link in the description below. It's completely free and takes just a few minutes to start receiving their newsletter. So thank you, Morning Brew, and thank you guys for joining me today. I hope you found this video helpful. If you did, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts on the report down below. Who do you put more trust into? Hindenburg, the short seller, or Carl Icahn? It's a bit of a toss-up. And yeah, we'll see you in the next one. Until then, see you in the next one.